Welcome and thank you for joining us here at Elevated Wealth Advisory. We appreciate you taking a few moments out of your busy day, and we plan on reviewing what took place in the markets in 2022 and what we could potentially expect in the year of 2023. We'll go over a few different topics, and if you have any specific questions that you would like to review, please feel free to send us an email and we'll set up a one-on-one call with us here at the office. As part of compliance, we always have to make sure that you review the disclosures, so please review these on your screen now. On today's agenda, we're going to look and review how the stock markets did in 2022, what drove that market performance, where we are now, and what do major financial firms predict for the year of 2023. Let's first start out with how did the stock market do in 2022. Here you can actually see what major banks and firms forecast for the closing of the S&P 500 for the end of 2022. The actual number was 3,839, and as you can see from Morgan, UBS, Wells, and a variety of other big banks, they were a little off with those numbers. Few, if any, major financial firms anticipated the market's sharp decline from historic high, which posted on the first day of the trading in 2022. It was a year of many surprises that forecasters simply did not anticipate. Two prominent examples of this were the Russian invasion of Ukraine and the unprecedented series of sharp interest rate hikes undertaken by the Fed. As you may recall, in 2022, the Fed suggested that inflation was transitory. Markets managed to cut some of the worst losses with a modest fourth quarter rebound, but it was overall a difficult year for investors. Remember, the S&P 500 composed of the 500 largest companies in the U.S. market, and all the numbers and topics we talk about today are based on past performance and are no indication of the future. In the following slides, we'll discuss a few factors that affected the stock's overall year. As this chart shows, you see nearly a year-long decline in stocks as represented by the S&P 500 index. The saying on Wall Street was, "Don't fight the Fed," which has never been more true than in 2022. Higher interest rates led to lower stock valuations as the Fed turned a monetary tightening policy. As you see from the first data point in January, inflation was already reaching levels not seen in many years. Inflation would accelerate from here and peak at a 40-plus year record high by mid-year before moderating, though we're still seeing relatively high inflation rates. In response, the Fed undertook an extraordinary series of steps to combat inflation, including raising its federal fund rates from near zero to over 4% in under 1 year. Matters made worse by Russia's invasion of Ukraine in February, which, in addition to human suffering and loss of life it cost, created multiple supply chain issues throughout the world. This led to increases in higher food and fuel prices, which exacerbated the growing inflation pressures that were evident before the invasion. The thought and topic of a recession was a major worry for many investors throughout the year. As with GDP growth, which was 6.9% in the fourth quarter of 2021, it fell for 2 consecutive quarters before rebounding a bit in the third quarter of last year. Stocks mounted a recovery in the fourth quarter as investors began to believe that peak inflation and the bulk of rate hikes were behind them, and that any recession in 2023 would not be as deep or as prolonged as earlier feared. This late year rebound, however, stalled as recession concerns returned for the market in December. Let's talk a little bit now about corporate earnings. Corporate earnings are one of the most important factors that drive stock prices over the long term. As the chart shows, their earnings growth for the S&P 500 companies decelerated in 2022, though some analysts believe that they may trend higher in the second half of 2023. Let's take a closer look here at American businesses that came roaring back from the pandemic, posting strong earnings growth in 2021. This was helped by consumers and also multiple stimulus payments that went on a spending spree, which helped the economy recover from the COVID pandemic. Their earnings growth rate also benefited from a favorable year-over-year comparative period. Earnings in 2022 were lower due to the national economic shutdown. Ironically, in 2022, earning results were hurt by the comparison to 2021's surge in earnings. But that wasn't the only reason for a slowing growth rate. Inflation squeezed profit margins, while consumers were left with less discretionary income after paying for higher priced food and energy prices. We have already touched upon some of these economic numbers, but let's spend a little bit more time getting a broader view of the economy in 2022. Economic growth contracted in the year's first half, posting 2 consecutive quarters of negative GDP. The third quarter expansion came as a bit of a surprise to many economists, but it did show the economy was proving resilient in the face of many of its challenges. An estimate of the fourth quarter growth by the Atlanta Fed is 2.8%. The labor market was a bit of a surprise in 2022 as well, with new jobs being added throughout the year, strong wage gains, and a steady unemployment rate. No one can overstate that inflation was the biggest economic issue last year, as the cost of nearly every consumer good and service rose. As you can see in the table, the inflation rate appears to moderate in Q4. A slowing economy, coupled with high gas and food prices, is a recipe for a pessimistic consumer. The table shows sentiment is quite low throughout the year. Its lowest level was in the second quarter when gas prices were near their all-time highs for the year. Finally, higher interest rates sent mortgage rates skyrocketing, making buying a home a lot more expensive. This has reduced buyer interest and led to slowing home sales. The housing measure in this chart is the sentiment index of home builders. Now let's review what we could expect in the year of 2023. To create some context about the economy, or where the economy stands on various factors, let's start by examining where we stood in November of 2020. I picked this month as a reference point since it represents a moment in which the nation was fully emerging from the pandemic, though not completely out of it, and Americans went to the polls to vote in national elections. As the indicators suggest, the outlook for the next 3 to 6 months was mixed. The Federal Reserve's monetary policy was still accommodative, and interest rates sat at historic lows. Nevertheless, the economy appeared weak, hurt by consumer sentiment and labor market. I want to draw your attention to the inflation in the bottom left-hand corner. It still looked unthreatening at that time. Now, let's fast forward to November of 2021. By then, nearly every measure to gauge economic prospects looks positive. There are no red indicators and only 3 yellow indicators. From monetary policy to consumer spending, the prospects for the economy for the next 3 to 6 months looked encouraging. Remember, at this time, heavy fiscal spending was stimulating the economy. Also, the Fed had not yet pivoted toward hiking interest rates, and COVID fears were starting to ease. As you can see, there are no green indicators a year later. This stands in sharp contrast to a year ago when we saw 17 green indicators. Last year, no red indicators. Today, there are 7. Monetary policy remains tight, inflation remains elevated, and higher interest rates are dragging down the housing market. In a nutshell, the near-term economic prospects appear tepid, and if a recession develops in the first half of 2023, the depth and duration of it may turn on whether the Fed eases up on rate hikes, the labor market continues to be resilient, and the consumer spending holds firm. Let's dive deeper into one of these economic speedometers, the leading economic index, or in short, LEI. The index includes 10 components, ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook trended lower throughout 2022. While no economic model is flawless, the data appears to support some forecasting of a recession in the first half of 2023. It's important to remind people that past performances may not lead to future direction. But as we review charts like these, history can suggest where we are in the economic cycle. It is important to remember that forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations as you see them expressed here. From the leading economic indicators and the economic speedometers we just reviewed, it's clear that the 2023 economy may face some challenges. The first headwind facing the market is inflation and rising bond yields. Both can hurt businesses. Inflation can make consumers less likely to spend on certain items, while higher bond yields increase business investment costs, reducing profits. Inflation remains above the Fed's target of 2%. But the good news is inflation is trending lower in the fourth quarter. If it continues its downward trend, it may give the Fed room to ease up on the size and pace of future interest rate hikes. That leads to our next potential market headwind, recession. As the Fed tightened monetary policy, the drumbeat of recession fears increased. Finally, geopolitical tensions are a potential headwind. Headline examples include the ongoing conflict between Ukraine and Russia and China's threat towards Taiwan. But it's worth remembering that it's often the geopolitical event that no one anticipated that surprises the markets. While the headwinds facing stocks are not to be underestimated, there are several potential tailwinds that may support the financial markets in 2023. In the final months of 2022, consumer price increases started trending lower. Falling inflation may boost consumer spending, which, in turn, could help corporate profits. Moderating inflation, as I just mentioned, may also give the Fed room to ease up or even pause on interest rate hikes in the year ahead. While inflation remains above the Fed's 2% target rate, fresh evidence of a downward trend may set the stage for more dovish monetary policy. One result of higher interest rates in 2022 was a rally in the U.S. dollar. A stronger U.S. dollar hurt some multi-international companies that generate part of their revenue overseas. Should the dollar weaken in 2023, it may help the bottom line of some of those companies. The cycle of higher interest rates may be closer to the end than the beginning. This would be welcome news by the financial markets. Finally, some will keep watching China, the world's second largest economy. With China's exit from its zero COVID lockdown policy, a more open China may herald a return to greater reliability to the global supply chains and reinvigorated demand for Chinese consumers, which may provide a welcome boost to the global economies. Before discussing the 2023 forecast, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is look at the PE, or price to earnings ratio, which measures what investors are willing to pay for a company's earnings. Look at the dotted line in the middle. You can see that the PE for the last 25 years is, on average, 16.84. You can also see that the PE moves quite a bit, with a peak near 1999 and a low in 2008. The chart shows that the PE was 15.15 on September 30th, 2022. Does that mean the stock prices will head lower or climb in the months ahead? That's difficult to answer. But it's fair to say that past performance does not guarantee future results. And the return in principal value of stock prices will fluctuate as market conditions change. Now let's take a look at the 2023 forecast. The share of gross domestic product, GDP, that comes from consumer spending is just a shade under 70%, which makes the financial health of the American consumer essential to economic growth. One of the reasons for the strong corporate earnings in 2021 was an excess of savings. These excess savings, which were built throughout the 2020 pandemic, were aided in large part by fiscal support, individual stimulus payments, and reduced consumption, as the chart on the left indicates. These savings started to draw down as Americans resumed spending with the economy reopening in 2021. However, as you can see from the chart on the right, these excess savings started to trend lower in Q3 of 2021. These excess savings may help provide some of the consumer spending that helps keep the economy from entering into a recession. But that may only be the case if the labor market remains healthy and consumers stay confident about their financial prospects. We'll talk a little about corporate earnings on this slide here. Corporate earnings may be another driver of the stock market performance in 2023. According to FactSet, a leading financial data and analytics firm, you can see that earnings are expected to trend slightly higher in 2023 after an up and down 2021 and the first half of 2022. Estimating quarterly earnings is difficult, but such estimates can help guide decisions about what price to pay for a stock. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on stock prices. It's important to remember that forecast or forward-looking statements are based on assumptions, subject to revisions without notice, and may not materialize. And if we've learned anything during the past couple years, the outlook for financial markets can change rather quickly. Let's talk about inflation and interest rates here on this slide. The course of stock prices in 2023 may be correlated to the path of interest rates in the year ahead. One tool traders look to understand where rates may be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates as implied by the 30-day Fed funds future pricing data. If we look at where the market thinks the Fed is going, we see the market believes there's almost a 50% probability of the Fed funds rate increasing from 4.75% to 5% by June end. At the end of 2022, the Fed funds rate is 4.25% to 4.5%. Traders also price in a 22% probability for a 25 basis points increase in the first 6 months of 2023. There's a 26% probability attached to a 75 basis point increase over that same time period. Keep in mind the CME Group's tables changes on a daily basis. Probabilities are based on assumptions and are subject to revisions. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in this table. As we approach the last few slides here and looking forward in 2023, let's circle back on GDP and unemployment rate. Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their outlook for Q4 2022 and all of 2023. They reduced their expectations for GDP growth, lowering their earlier estimates in each of the next several quarters. They do see a rebound in economic growth in Q4 2022, however. Interestingly, their unemployment rate projections have stayed mostly unchanged through the first half of 2023, with a slight uptick toward year-end. It would be reasonable to think that a sluggish economy might influence the unemployment rate, but that may not be the case. We'll discuss the possible reasons for why that's split in the next table. I've said this before, but it's important to remember that forecasts are based on assumptions and subject to revisions over time. Despite a softening economy in 2022, the labor market was remarkably resilient. The series of charts that we're looking at examines the JOLTS data. JOLTS, or Job Openings and Labor Turnover Survey, is a monthly government report that examines the state of the job market from the perspective of current job openings and turnover. Let's first look at the chart on the left, which indicates the ratio of the number of job openings to the number of unemployed workers. Coming out of the pandemic, the number of job openings rose as business looked to hire staff to meet demand. Now, turn your eye to the upper right chart. The rise in JOLTS quits is what many called the Great Resignation. Following the pandemic, many people reevaluated their lives and jobs, leading them to quit for a newer career or drop out of the workforce entirely. Finally, the lower right-hand chart shows the trend in JOLTS layoffs, which after pandemic-related spike has trended lower. After a difficult year, forecasters are a bit downbeat about the prospects for 2023. As you can see, some firms are projecting a year-end close on the S&P 500, not far from the market's 2022 close of 3,839. Of course, no one knows for sure what equities will do in 2023, and predictions at this stage are just that, predictions. I've said this before, but it's important to remember that forecasts are based on assumptions and subject to revisions over time. We've covered a lot of information for most of our discussion on what drove the market and what we expect to move the market over a short period. As this chart shows, the performance of a hypothetical 60% equity and 40% bond portfolio was down through the first 3 quarters of last year, with negative returns for both stocks and bonds. Our chart starts in 1977, and as you can see, it was the first time that both asset classes had actual losses. In this illustration, stocks are represented by the S&P 500 Composite Index, which is a representation of the overall U.S. stock market. Bonds are represented here by the Bloomberg Aggregate Bond Index. Again, index performance is not indicative of the future, and past performance does not guarantee any future results. We appreciate you joining us here today here at Elevated Wealth Advisory. I know some of this content can be dry and boring, but we wanted to give you an idea of what the markets did last year and some of the predictions we are looking at for the future. We do have a series coming out about retirement planning in the near future in which we'll talk about various topics. Stay tuned for more information.